Is quantitative easing a form of open market operations? Have you ever wondered how central banks influence the economy? One key method is through open market operations. Today, we will explore if quantitative easing fits into this picture. Open market operations are routine activities where central banks buy or sell government securities. These transactions help regulate the money supply and control short-term interest rates. By doing this, central banks aim to stabilize the economy under capitalism. Now, let's talk about quantitative easing. This is a specific type of open market operation, but it stands out in several ways. While both involve central banks purchasing securities, quantitative easing is considered an unconventional approach. Traditional open market operations usually focus on short-term treasury bills. In contrast, quantitative easing targets longer-term securities, such as government bonds and mortgage-backed securities. The scale of quantitative easing is also much larger. Open market operations are typically smaller and more frequent. Quantitative easing involves significant purchases over a longer period, often months or even years. This approach is usually adopted when traditional methods are not enough, like during times of economic stagnation or near-zero interest rates. So, what are the goals of quantitative easing? The primary aim is to lower long-term interest rates and increase the money supply. This encourages lending and investment, especially when conventional monetary policy tools have limited impact. In times of economic downturn, quantitative easing acts as a last resort measure to combat deep recessions or deflationary pressures. From the perspective of capitalism, both open market operations and quantitative easing representing government intervention in financial markets. This intervention is aimed at stabilizing the economy and supporting market confidence. Open market operations help maintain the smooth functioning of credit markets. Meanwhile, quantitative easing reflects a more aggressive response to extraordinary economic challenges. In summary, quantitative easing is indeed a form of open market operation. However, it is distinguished by its unconventional nature, larger scale, and focus on longer-term securities. These differences allow it to influence broader economic conditions when traditional methods fall short. Understanding these tools helps us see how governments work to stabilize economies and support growth in a capitalist system.